Good evening, everybody, and thank you for joining us once again on this edition of the monthly Equity Market Insight. Delighted to have all of you join us here today. This time, and as usual, I have one of my fund managers join me on this call. So this month we have Sharwan Goyal, who's the head of our passive strategies as well as our quant and arbitrage strategies. So he's going to be on this call with me. And from the product side, this time we'll have Ankit Singhania, who is from the product side on the passive side of our business. So slightly different set of members joining me on this call today. And the way we'll be doing this call is pretty similar to how we do it every time, which is first I'll run through a brief presentation on the economy and markets. And you'll see a slightly revised deck over there, which your familiar colleague from the product team, Niranjan, has put together. So any feedback on that new deck is most welcome. And after that section, I'll hand over to Sharwan, who will talk about our UTI Multi Asset Fund. That's the fund of discussion today. And as usual, we've already received a few questions from you, and Ankit will take some of those questions and read them out to us, as well as any questions that you choose to send us as part of this live conversation we are having today. So without any further ado, I'll just request my colleagues to bring up the presentation on the screen. Hopefully that's now up there and visible to all of you. So we'll just move on to the next slide. So we've sort of, as I said, modified the deck. So from now onwards, every time we'll start with what we call the chart of the month to highlight something significant in the economy, in the markets. It could be in earnings, but some facet of investment. And this time what we've looked at is the capital investment ratio. Now, most of you would be aware that the capital investment ratio in India has been in a decline for almost a decade. The peaks that we saw in the capital investment ratio, or rather gross fixed capital formation as a percentage of GDP, actually happened almost about 15 or 16 years ago. Here, of course, we have the data from 2010, and you can see the peak of 36% of GDP being investments in 2012 financial year. And ever since then, it's been in a very gradual decline. Last year, FY22, we saw almost a 200 basis point increase in this ratio. And once again, there is some hope that perhaps corporate India, as well as the larger economy, might start to see a revival in investment sentiment. This will obviously be good for the economy. This will be good for job creation and eventually for income growth as well, because we need to invest to be able to drive the economy in the future. Now, on the next slide, we wanted to show you some data which gives you some reason to believe why the initial ingredients might be quite favorable for a strong pickup in capital investment. I would say that the initial conditions which are favorable, first on the right hand side, you can see corporate leverage. And what this essentially shows you is that corporate leverage in terms of net debt to EBITDA is at a record low level. This is in fact the lowest that we are seeing in terms of corporate net debt to EBITDA over almost 20-year period. I think the last time we were at a net debt to EBITDA which was so low must have been somewhere around 2003 or 2004. So corporate leverage very low. You know that corporate India has seen a profit boom in the last 2 years. We'll see a slide about that later. So at least in terms of their ability to invest, they are well positioned. And on the left hand side, you have the bank NPAs as a percentage of gross advances, and you can see over there that this ratio as well is now in a steady decline. In fact, this is not yet updated for FY23 year-end numbers, but my suspicion is that once we see the full year FY23 numbers getting updated in the slide, you will see a further decline in that ratio. So when you think about the drivers of capex as well as the banks who typically tend to fund a lot of that capex, both are in a position where they can start investing, and the banks are in a position where they can start lending to businesses who need money in order to invest. So certainly the essential ingredients for a reversal in gross fixed capital formation to GDP are very much in place. So that's sort of the opening salvo in terms of capex. Let's quickly look at the next section, which is economic trends. I won't spend too much time on this, but the way to look at this table is you can see the data from FY16 all the way to FY22. Then we have the current RBI and Bloomberg forecast for the next 3 quarters, and then we have the financial full year forecasts, which are available from Bloomberg. And what you can see over there is that there is some deceleration from FY23 into 24 and 25. The Bloomberg consensus forecast for real GDP, the top row is 6% for FY24 and 6.3% for FY25. RBI's numbers are actually slightly stronger than this. Their FY24 forecast is about 6.5%. If you look at the external balance row here, current account deficit, remember FY23 at one point of time, the CAD was running closer to almost 3% annualized, but it came in at about 2.1% after crude oil prices and fertilizer prices cooled off, and that is now expected to be well within the comfort zone of the central bank over the next 2 years. Moving on from this to the next slide, this is really a slide showing high frequency indicators. I won't say too much over here except to just point out that, these are high frequency indicators. This data is there for you as a reference point. And certainly if there is something that, we'd like to point to, we'll highlight it. This time I just wanted to suggest that you look at the Forex reserves number. Remember there was, a very sort of steady decline in Forex reserves. But we are now seeing a reversal with foreign exchange reserves starting to pick up all over again. And this table should actually read March 22 all the way up to April 23. Moving on to the typical normal section that you see, which is the equity markets and valuation slide. We'll just move straight to actually this slide, which shows you the different market segment performances. Now, as you know, January, February were fairly difficult months for the market, but we've seen a pretty sharp rebound, I would say, from somewhere in the middle of March. The market has rebounded quite well, and you can see that in the performance of the indices. And in fact, there's been a bit of a risk-on appetite in the marketplace. So actually, the mid-cap and the small-cap are the best performing indices over a month, and over a year. The mid-cap is the best performing index. And the small cap, of course, yet to fully catch up with the Nifty 50. But what is the picture in terms of valuations? We'll take a look at that on some of the later slides. With the strong recovery in India over the last 3 months, we're also seeing India sort of go back to top of the league tables on a one-year basis. So on a one-year basis now, India is sort of the second best performing market in this bunch of markets, and that's basically a function of its strong performance on a 3-month basis, which has helped it recover over a one-year period. So India once again doing quite well in a global context. Diving on from this to our regular discussion on earnings. The earnings for March 23 are now fully in. What were the earnings like in March 23? Eventually, the year ended with a 5% earnings growth. This is much more subdued than what was expected almost a year ago. We'll see that on the next slide. But crucially, the expectation as per Bloomberg consensus for the period FY23 all the way to FY25 is that earnings are expected to grow at a CAGR of about 18%, with almost a 21% earnings growth expectation in March 24, followed by 15% earnings growth in March 25. So that's the Bloomberg consensus expectation for the next 2 years, and we'll discuss that later. What's the picture in terms of how earnings estimates have been behaving? We've changed this template. You can see the new template on the slide in front of you. On the left-hand side are the 4 bars for FY23, and you can see how the expectations for March 23, over the period of a year saw a cut of almost about 7 or 8%. The expectation in June 22 was March 23 EPS would be about 886, but by the end of the year, the expectation came down to 832. And remember, the actual number actually came in at 817. So almost a 8 or 9% cut to the expectation of EPS that was there in June of 22, exactly a year ago in terms of delivery. For FY24, the four bars in the middle show you where the estimates were in September 22 and all the way up to the current bar, which is the blue bar, 987. That's the expectation for Nifty 50 EPS in March 24, which is now about 10 months away. And you can see that number, after an initial bump up, has more or less been stable over the last 9 months. And of course, we also have the earnings estimates for FY25, but I do think that's a little bit away in the future and won't spend too much time on that. But the big picture, actual earnings for FY23 came in much lower than what was anticipated a year ago. Expectations for March 24 have been stable for about 9 months. Is there any risk to these numbers? We'll talk about that later. Moving on to the slides on valuation. So we've got here the Nifty trailing PE on the left-hand side, Nifty forward PE multiple on the right-hand side. And as you can see, it's somewhere between that yellow line and the red line, very much in the comfort zone. In fact, remember, any valuation between the green line and the red line is in the comfort zone. When valuations are in that sort of light orange zone, that's when valuations are expensive. When valuations are in the green zone, they are cheap. Right now, we are somewhere in between those two areas, above the long-term average, but not yet in expensive territory. Remember, the market's sort of been flat now for almost about 18 months, but because earnings have gone up 40% plus during this period, effectively valuations have come down, even though prices in the market have gone nowhere. What do valuations look like in terms of price to book? We can see that on the next slide. Again, these valuations somewhere between the long-term average, which is the yellow line, and the expensive zone, which is the red line. And over the last, 18 months or so, valuations have worked themselves off from the extreme levels that we had seen earlier. And return on equity, after recovering very steeply over the last 2 years, is now once again sort of starting to see a little bit of a reduction. Nothing too dramatic. I don't think there is a trend to be identified or ascertained over there, but it's sort of more in stable territory now after having reached the 14% mark. What do valuations look like for other segments of the market? The Nifty mid cap and the Nifty small cap. You can see the valuations here. Left hand side is the mid cap price to book, right hand side is the small cap price to book. The small caps have been the segment of the market which have been looking a little bit more pricey relative to their own history, not necessarily relative to large caps or mid caps, but relative to their own history. They did briefly enter the fair value zone a few months ago, but with the recent rally, they have pushed back into what I would consider to be the expensive zone. As far as mid caps are concerned, they look more like the large caps, at least on a price to book basis, sort of in the fair value zone at this point of time, above the long-term average. So moving on to the next slide, this is again something that you're familiar with. This is a comparison of the Nifty 50 yield to the 10-year GSEC. The way we do this is you take the Nifty 50 PE multiple, and the Nifty 50 yield is nothing but 100 divided by the PE multiple of the Nifty. It's what we call the earnings yield. And then you have the 10-year GSEC yield. You subtract these two numbers. Typically, this number tends to be negative. The long-term difference is minus 1%. Currently, it's about minus 1.58%. There was a point in time a few months ago where it was about 2%, which was very attractive in terms of bonds. But now with bonds also rallying about 30-45 basis points, we are now, I would say, getting closer to sort of neutral territory, slightly in favor of bonds, but really closer to neutral at this point of time is the way I would read it. The next slide is once again large caps versus mid caps. We've already discussed this, so we'll sort of move on from this slide to sort of look at a summary of where we are in the world today. I think one of the surprises in the last 10 days has been that Australia, New Zealand, and Canada, the central banks have surprised the markets with rate hikes, because this was not the expectation that these central banks would be hiking, but they did. In the US as well, actually now the market is giving a decent probability to the potential of one more rate hike happening in the July meeting, not the June meeting, which will happen next week, but the July meeting. And the expectation, if you remember last month, we discussed it, was that almost 80 basis points of rate cuts would happen by the US Fed in calendar 2023. I think that expectation has now changed quite dramatically. Now the expectation is there may be barely one or two rate cuts in calendar 2023. The market expectation has dropped from 80 basis points of rate cuts closer to 20-25 basis points. Global growth outlook remains slightly sluggish. IMF recently put out its global growth numbers and they cut pretty much across the board. Commodity prices indicate a weak global growth outlook. Shipping freight rates indicate a weak global outlook. Most other global economic indicators also pointing in the same direction. In India, MPC, which is the Monetary Policy Committee, had its meeting yesterday, or rather over the last 3 days. And yesterday they announced that they would remain on pause, so no hike. This is, of course, the second consecutive meeting where they are remaining on pause. However, they did retain their policy stance as withdrawal of accommodation. I would say at the margin, there was some perhaps disappointment relative to expectations of rate cuts later during this year, because the governor, particularly in his commentary, reiterated the commitment to a 4% consumer price inflation number, and that in a sense would dampen expectations of a pivot in policy. For the fourth quarter of 23, Nifty 50 companies' earnings grew by a healthy 16% year on year, so much better in the fourth quarter as compared to the full year number, which is more like a single-digit growth number. But I would say even that 16% is sort of a barbell effect. There were some sectors which did brilliantly and other sectors which did very poorly. So distribution was very, very unequal when we look at overall earnings growth distribution. We believe there is risk to earnings estimates in 24. Can 21% earnings growth take place? I think there is risk to that number. Why? Because earnings face a headwind from slowing economy. Fiscal policy, remember, Government of India is trying to cut the fiscal deficit, 5.9%, medium-term target 4.5%. That is a restraint on the economy. And further, RBI's own policy of staying on pause and extended pause, arguably, in effect, leaves the monetary policy settings at restrictive. Equity valuations more in the comfort zone, though above the long-term average. Our thought process is that investors should continue to adopt a staggered approach towards equities. Neither are the indicators blinking red, nor are they blinking green. It's sort of in the middle end zone, and staggered investments are the best way to deal with the markets in this kind of environment. So that's sort of it in terms of the big overall macro picture. I'm going to pause over here and invite in my colleague, Sharwan Goyal, who will now talk about the UTI Multi Asset Fund, which sits in the SEBI category of multi-asset, which means that it invests in 3 asset classes. But I will let Sharwan talk further about that. Over to you, Sharwan.
Yeah, thank you very much. So we have recently relaunched our multi-asset fund, which is providing asset allocation across 3 asset classes, which is equity, gold, and fixed income. And the call is based on the relative valuations. So we have developed in-house proprietary financial model. The model is guiding us on asset allocation. So based on relative valuations, model is assisting us on equity, gold, and fixed income allocation. And to check the efficacy of this particular product, we have implemented this particular model in our multi-asset fund about a year back. And since then, this particular fund has done pretty well. So rather than taking a view on asset allocation based on fundamentals or business fundamentals or based on subjectivity, the financial model is helping us in terms of asset allocation. So some of the factors which Vetri has evaluated in his slides, we are broadly using those factors to determine asset allocation. So first and foremost, currently UTI Multi Asset Fund is having, in terms of asset allocation, 65 to 80% allocation to equity, 10 to 25% each to fixed income and gold. Although unhedged equity or net equity allocation varies from 40 to 80%. So if model is suggesting us to reduce equity allocation below 65%, in that case, we will take help of arbitrage, and with the help of arbitrage, we will reduce equity. But the gross equity always remain more than 65% because this is equity oriented fund wherein we need to maintain equity allocation more than 65% all the time to get equity taxation benefit. So from a taxation point of view, this will always remain a equity oriented fund, because generally equity funds are taxed favorably as compared to other products such as fixed income and gold. So from that perspective, it is a very tax efficient fund because you are getting equity taxation benefit here. If you look at performance of various asset class in different market environment, then you will find that different asset class behave or perform differently in different market environment. So here we have broken equity market returns in last 20 odd years in different events. So for example, during tech bubble, equity corrected about 17%. In that time, gold and fixed income has performed well. So whenever equity market has gone through tough time and wherein because of certain external or certain issues, if market is exhibiting a lot of volatility in those market environment, fixed income and debt as an asset class is performing much better. So for example, during global financial crisis, wherein market corrected 52%, equity market corrected 52%. In that period, gold and fixed income perform far better because different asset classes have different correlation with each other. So typically, asset allocation helps us form a portfolio of different asset class which are having either low allocation to each other or negative correlation with each other. So typically, if two asset classes are having low correlation to each other, in that case, movement of those two asset classes is not linked to each other, which means that if one asset class perform well, there is no certainty that other asset class will behave either similarly or in opposite direction. But if two asset classes are having negative correlation, then most of the time the movement of those asset classes is in opposite direction. If one asset class is showing strong performance, generally other asset class perform weaker. So depending upon correlation, if you are having a portfolio of asset classes which are not exactly related to each other, generally the risk-adjusted returns are far better because the overall portfolio volatility could be reduced because of that. So our financial model will help us reduce the volatility of the portfolio without compromising on the returns in a big way. So if you look at performance of various asset class such as equity, fixed income and gold in last 25 years, then you will find that these asset classes are having very different returns and risk profile. So for example, equity as an asset class has delivered far better returns as compared to other two asset classes, but at the same time, equity as an asset class is far more volatile as compared to fixed income and gold. So as you can see here, equity has delivered 13.6% return, but at the same time, volatility is 22%, which is far higher than other two asset class. Similarly, in case of fixed income, volatility is far lesser, but at the same time, return potential is also much lesser as compared to equity. While typically gold has negative correlation vis-a-vis equity, and whenever equity is exhibiting extreme volatility, generally we have seen that negative correlation further increases between equity and gold. And so gold is providing perfect hedge against market turmoil. Whenever market is exhibiting weakness or it is going through difficult phase, we have witnessed that gold as an asset class is providing downside protection. So if you are combining these three asset classes in a certain proportion, then generally you will get desired outcome. So for example, if you are combining equity, fixed income and gold in 65% equity, 25% fixed income and 10% gold, then you would have generated 12.7% return, which is slightly lower than equity, but at the same time, volatility would have been much lesser. As compared to 22% volatility could have been just about 14%. So depending upon your investment objective and your risk profile, you can combine various asset class in different proportion to get the broad desired outcome. Because in the long-term wealth creation journey of the investor, the journey is also equally important. The path to wealth creation is also very important. So if you are having allocation to different asset class which are not related to each other, in that case, you can get much more stable returns as compared to very volatile returns if you are investing large pool of money in a particular asset class. So if you are investing in dynamic asset allocation model, in that case, any positive outcome or alpha because of that dynamic asset allocation could further improve your returns, because we have witnessed in the past that equity as an asset class has a tendency to revert back to mean valuations. So whenever markets are trading at expensive valuations, we have seen that next 1 to 3 years returns tend to be weaker. While whenever markets are trading at attractive valuation, we have witnessed that next 1 to 3 years returns tends to be better. So because of this tendency to revert back to mean valuations, if any dynamic asset allocation model based on valuations approach could help us generate much better returns. So we will talk about the asset allocation model in subsequent slides. So we have come up with a proprietary financial model. So let's understand this model with the help of football team. So a football team which is having combination of forward players as well as defenders. So typically team managers decides different combination based on strength, either strength of the opponent or league position of that particular team or required outcome. If they really want to win the match because they are lagging behind in terms of as compared to other teams in the league, in that case they can form a formation which is aggressive. Likewise, if they are going playing with a team which is far better, in that case they can go for defensive formation. So depending upon the status of the league or depending upon the opponent that they are playing, the team manager can form a different strategies. So typically 4-3-3 kind of strategy, wherein 4 defenders, 3 midfielders and 3 strikers is considered slightly aggressive formation. But if they believe that if they are good enough to go for draw, in that case they can follow slightly different formation or slightly in the sense defensive strategy, wherein they can have 5 defenders, 3 midfielders and 2 strikers. So likewise in multi-asset fund, our model plays the role of football team manager, because rather than having any personal biases, the model will guide us on asset allocation depending upon relative valuations of different asset classes. And we have seen that having a dynamic asset allocation actually could help you generate much better outcome as compared to having static allocation. So investors have 2 choices to make. They can either do asset allocation on their own, which means that they have to go through the tough process of selecting certain asset classes which can perform well for them. At the same time, they have to keep rebalancing the portfolio on regular basis, because if you don't rebalance the portfolio, in that case, your allocation to particular asset class could be much higher than what you initially intended to. So, but at the same time, asset allocation at investors level is easier said than done, because generally we as a human being are having certain emotional biases, and generally whenever markets are doing better, we generally become greedy, and rather than selling portfolio or selling equities at that point in time, we become greedy and actually end up buying more equities. At the same time, whenever market is exhibiting volatility or going through tough time, rather than increasing equity allocation because of those emotional biases, we tend to reduce equity allocation. Similarly, we have seen that during COVID wave, wherein most of the investors become nervous because they were not aware about the uncertainty of the pandemic, how pandemic will play out. So most of the investors become nervous, and rather than buying equities, they end up selling equities. While financial model based on certain valuation criteria would have actually increased allocation. Similarly, our dynamic asset allocation model has suggested in substantial increase in equity asset allocation during first wave of COVID, when market has fallen about 35%, because at that point in time, market was trading at substantial discount as compared to long-term average valuations. And generally, we have seen that any investment done at attractive valuation would generally have tendency to generate much better outcome as compared to if you are investing in equities whenever market is trading at expensive valuations. So rather than investing on their own, going through tough process of selecting asset classes, at the same time selecting schemes within each and every asset class, one can choose to invest in a dynamic asset allocation oriented fund, which will keep on changing allocation towards different asset class depending upon the relative attractiveness of those asset class, without getting affected by the behavioral biases of investing. So dynamic asset allocation or UTI Multi Asset Fund is providing that kind of solution, because this particular fund is getting benefited from the dynamic asset allocation model, and model is guiding us on asset allocation. So whenever equity as an asset class is trading at attractive valuation, at that point in time, model has generally signaled increase in equity allocation, and whenever market is trading at expensive valuation, at that point in time, model has signaled reduction in equity weight. So it's a evidence-based and evidence-based way of investing in different asset class rather than getting influenced by emotional biases. So let me further go into details of our proprietary model. So we have developed a proprietary financial model which is based on 4 valuations related factors. So the 4 valuation related factors are 1 year forward price to earning ratio, price to book value ratio, dividend yield, and yield gap. So for the broad market cap oriented these valuation criteria such as P ratio, price to book value, and dividend yield, we are using Nifty as a benchmark. So we are computing these valuations of Nifty. At the same time, as Vetri has also alluded, in case of yield gap, which is relative valuation approach, which is showing relative attractiveness of equity vis-a-vis bond. So whenever equity as an asset class is trading at attractive valuation, at the same time, whenever bond yield is higher, at that time, equity on relative basis become much more attractive. So basis these relative as well as absolute valuation parameters, the model is suggesting a certain asset allocation. Similarly, on gold allocation also, we have seen that gold and equity generally behaves differently in different market environment. And we have seen that if gold is performing well in a certain period, generally in the subsequent period, equity is performing well. So basis relative performance of gold vis-a-vis equity, we have developed a model which is suggesting us gold allocation as well. So in last 1 year, the model has suggested initially increase in allocation towards 25%, and in last 3-4 months, when gold has rallied, in that period, the model has suggested to reduce gold allocation to about 10% now. Similarly, fixed income allocation is also decided because we are using relative valuation approach also. So it's not only residual part which is going to fixed income, because we are using a relative valuation approach also, which is yield gap. So basis these criteria, the model is suggesting us certain asset allocation, which we are following in the model. So if you look at this particular table, then you will find that markets has tendency to revert back to mean valuations, and generally any investment done when market is trading at attractive valuation yields far better outcome as compared to period wherein you are investing when market is trading at expensive valuation. For example, on an average since 1992, whenever market is trading at very attractive valuation of either 9 to 14 P ratio or 14 to 17 P ratio, generally next 1-3 year returns are far better as compared to period wherein market is trading at expensive valuations, because market has a tendency to revert back to mean valuation. And because of this nature of the market, the model will also take a call based on 3-4 valuation parameters. So rather than using a particular factor, because P ratio could be influenced by lumpiness of earnings in a particular year. So rather than using a particular factor, we are using 4 factors which are although related to each other, but in a particular period it could have different outcomes. So basis 4 different valuation criteria, we are selecting allocation towards equity, fixed income, and gold. So these are the four valuation parameters which we are using: P ratio, price to book value ratio, dividend yield, and yield gap. So as you can see here, we have shown here equity allocation vis-a-vis these 4 parameters or factors. As you can see that the yellow color wherein we have shown model equity weight or allocation to equity. As you can see that there is an inverse correlation in P ratio of Nifty vis-a-vis our equity allocation. So whenever the earnings P ratio is much more attractive in that time framework, model is suggesting higher equity weight. For example, during COVID wave, when market corrected about 35% and it was trading at deep discount as compared to historical averages, at that time model signaled increase in equity allocation to about 75%. Likewise, post-COVID, there was very strong rally, and when market was trading at close to +2 standard deviation, which was trading at much higher valuation as compared to historical averages, model suggested reduction in equity weight to about 40-45%. So based on relative valuation, model will keep guiding us on equity allocation. Broadly, P ratio and price to book value ratio, from broader perspective, they are broadly linked to each other. So in terms of price to value ratio also, you will see that there is an inverse correlation in allocation towards equity as compared to price to book value ratio of Nifty. While P ratio and price to book value ratio are inversely correlated to next 1 year market movement, but at the same time, the two other factors such as dividend yield and yield gap are having positive correlation to next 1 year market returns. So, for example, typically corporates generally have ability to pay higher dividend whenever their balance sheet strength is much better. At the same time, whenever market is going through tough time, and if companies maintain their dividend per share, in that case, a dividend yield starts improving. So that's why this particular factor or model will have positive correlation to dividend yield. So whenever dividend yield of Nifty has improved, in that time framework, model has suggested higher equity weight. And whenever dividend yield has fallen in that time framework, model has suggested reduction in equity weight. Similarly, on equity valuations vis-a-vis bond, which Vetri has also mentioned in his initial remarks, that whenever equity as an asset class is trading at much attractive valuation as compared to bond, in that time framework, model has suggested higher equity weight. So basis combination of these four factors, rather than having certain allocation to each and every factor, there is a statistical model which is combining these four factors, and basis combination of these four factors, model is suggesting us certain equity allocation. But suffice to say that basis P ratio and price to book value ratio, it's inversely correlated, but dividend yield and yield gap is positively correlated to market returns. And likewise, model will suggest similar equity weights. If you look at performance of the model basis or next 1 year return of the markets, for example, we have mentioned equity allocation in top chart, while next 1 year market return is mentioned in the bottom chart. So, for example, the above chart is starting from January 2011, while the below chart is starting from January 2012. So here intention is to look at what model has suggested in terms of equity allocation and how market has performed in next 1 year. So, for example, in 2013, market has recommended 75% equity weight, and next 1 year return was about 20-25%. Similarly, when market has suggested reduction in equity weight, next 1 year returns was slightly better. So most of the time, because market has tendency to revert back to mean valuations, most of the time model is able to predict the market movement from 1 to 3 years perspective. Although market could still rally from expensive valuation zone. So it's not always that model is able to predict the event rights, but most of the time model is able to predict the market movement because market has tendency to revert back to mean valuations, and whenever market is trading at expensive valuation, in that time framework, model will suggest lower equity weight, and whenever market is trading at attractive valuation, in that time period, model will suggest higher equity weight. So, for example, before COVID wave, model was suggesting lower equity weight of about 50-55%, and returns was about 10-20%. But post COVID, during first wave of COVID, when market fallen drastically, we have looked at the chart wherein P ratio has fallen after 35% fall in the market. Model suggested 75% equity weight, and thereafter we have seen very strong returns of equities. But post COVID, after rally in the market, because valuations were pretty expensive, at that point in time, model has suggested lower equity weight. So depending upon relative valuations of based on four factors which we are using in this particular model will keep guiding us in terms of different asset allocation, either equity, fixed income, or gold. Moving on. Similarly, for gold allocation, as I mentioned earlier, gold allocation also we are doing based on relative performance of gold vis-a-vis equity, because time and again we have seen that these two asset class keep reverting to mean, which means if gold is performing well for certain period of 1 to 3 year period, in that case in subsequent period equity is performing well. So based on relative performance of gold vis-a-vis equity in recent past, we are deciding the allocation towards gold as well. So as you can see that in last 20-25 years, there are about 6,000 observations, and on an average, gold to equity ratio is about 2.81. So which is average line mentioned in orange here. While current gold to equity ratio is about 2.05. So currently, in the longer term perspective, gold is trading at attractive valuation, because gold has underperformed as compared to equity in last 25 years. So as you can see that in the bottom table, we have mentioned performance of gold to equity ratio, and how market or gold has performed in subsequent 1 year period. So whenever gold to equity ratio is below 2, which means gold has underperformed equity in recent past, in that case, on an average, in next 1 year, gold has delivered 18% return. And there are 17% such observations that we have witnessed in last 25 years. Similarly, whenever gold to equity ratio is very expensive of about 3.5, in that case, next 1 year gold return tends to be far weaker. Just a second. Here we have shown performance of the model in last 11-12 years. So we have mentioned annual performance of Nifty, Gold, and 10-year GSEC, which are the 3 asset class that we are using in this particular fund. Then the model portfolio, which is combining equity, gold, and GSEC or bond in different period. So these are the has delivered 24.5% return in 2012. While likewise, we have shown performance of the model in each and every year. So most of the time period, model has suggested appropriate asset allocation and has generated alpha, barring a couple of years wherein it has underperformed. But in last 11-12 years, it has delivered 13.4% return, which is slightly lower than Nifty. But at the same time, it has done much better as compared to benchmark, delivering about 1.6% alpha. So as I mentioned in my initial remarks, that we have developed this in-house proprietary financial model, which is allocating to different asset classes. So we have implemented this in our multi-asset fund about a year back. So here we have shown performance of the model vis-a-vis benchmark in last 1 year. So in CY22, model has generated 9.2% return as compared to 5.24% for benchmark, delivering 3.8% alpha. So in last 1 year, in 2022, model has signaled reduction in equity weight at when market was trading at expensive zone, and whenever market has corrected, it has suggested increase in allocation. So we have got, sorry, give me a second. So CY22 was a sideways market, which means market has broadly remained flattish, delivering just about 5-6% return. But there were a lot of movement in the market, and model has beautifully captured those movements. So that's why model has generated better returns as compared to benchmark. Similarly, on gold side also, when gold was trading at attractive valuation of about 50,000 rupees for 10 grams, at that time, model has suggested reduction in weight from when gold was priced at 46,000, while it has suggested increase when prices fall to 48,000 rupees. Similarly, when prices moved up, at that time, model started showing reduction in allocation towards gold. So based on relative performance of equity and gold, model will keep suggesting allocation to these asset classes. And we have seen that because of market have tendency to revert back to mean valuations, and whenever market is trading at expensive valuation zone, model will signal lower equity weight. And whenever market is trading at attractive valuation zone, in that case, model will signal higher equity weight. Similarly, here we have shown performance of the model in last 1, 3, 5, and 10-year period. As you can see that model has broadly delivered equity kind of returns in last 10 years, marginally lower than equity, but at the same time, volatility of the model is much lower as compared to equity as an asset class. And because it is generating similar return as compared to equity, but with far lesser standard deviation, because of that, relative risk-adjusted returns are far superior as compared to the benchmark. So in last 1 year, it has delivered 1.01 risk-adjusted return as compared to 0.44, and most of the time period it has delivered much better outcome on risk-adjusted basis. Moving on. So here we have shown movement of model of UTI Multi Asset Asset Fund, which has generated 6.7% return in last 1 year with 9.6% volatility, while the Nifty, which is equity benchmark, 2.2% return with 14.4% volatility, while bond has delivered 4.9% return, while the benchmark on which is combination of these asset class in static manner, which is 65% equity, 10% gold and 25% fixed income, has delivered 4% return in last 1 year with 11.3% standard deviation. So UTI Multi Asset Fund has generated much better outcome in last 1 year in a sideways market wherein we got a lot of triggers right, and that's why we have shown performance of UTI Multi Asset Fund, because we have implemented these asset class, the dynamic asset allocation across equity, gold, visa, and fixed income in last 1 year, and it has delivered good outcome in last 1 year. So to broadly sum up, so rather than investor taking a call on asset allocation wherein investor needs to take a call on different allocation to different asset class depending upon relative valuations, which is easier said than done, because we as a human being are having certain emotional biases, and generally we get greedy whenever market is trading at expensive valuation zone, and we get influenced by recent market rallies and we don't care about valuations. So because of that, generally the valuation or the allocation towards different asset class may not be most appropriate. So rather than investors doing asset allocation on their own, either static allocation or dynamic asset allocation, because it is getting influenced by human biases, which may or may not yield better returns. But at the same time, if investors are doing asset allocation on their own, in that case, there are a lot of transactions as well as tax incidents, because every time they are buying and selling these asset class, there are transaction costs. At the same time, whenever they are booking profits, they have to pay capital gain tax. While because mutual fund schemes are exempt from capital gain tax as well as dividend income tax, because mutual fund schemes, whenever they are booking profits, they don't have to pay tax. Tax is ultimately paid by the investors when they are realizing gain in the fund. So if you are staying invested in UTI Multi Asset Fund for 10-year period, so in that 10-year period, you don't have to pay any tax. Whenever you are realizing the gain after 10-year period, in that case, you have to pay tax at that point in time. At the same time, UTI Multi Asset Fund is having equity status of the fund, so which means that you have to pay 15% short-term capital gain and 10% long-term capital gain, while taxation is much higher for debt and fixed income. So despite having allocation towards these three asset classes, it is tax efficient way of investing in a dynamic asset allocation fund. So that's why we recommend you to consider this particular fund as an alternative of investment in various asset classes. Thank you.
Thank you, Shravan. Thank you for such a detailed discussion on the fund. Now we'll start the Q&A session.
Sure.
And so the first question, Shravan, is for you, is that in terms of the overall asset allocation strategy, what is the equity strategy, that how the active stock picking will happen in the multi-asset fund?
Sure. So stock selection is basis combination of quantitatives as well as fundamental research. So we are selecting stocks from UTI universe. So currently we are tracking about 350 stocks. So after removing stocks which are illiquid or smaller in size, the active universe is about 250 companies. So out of these 250 companies, we are selecting stocks basis different quantitative approach. So based on either momentum, quality, value, whichever asset class is, whichever segment of the market is trading at attractive valuation zone, we are having higher allocation towards that particular segment of the market. So it's based on combination of quantitative as well as qualitative approach.
Thank you. The next question, Vetri, is for you, that how much fall is expected in the market, say for broader indices like Nifty and Sensex from the current levels, considering that there is no event that is happening. Without any event happening, what is the fall expected in broader market indices like Nifty and Sensex from these levels?
Well, I think the only way to answer that question is to say that, look, at any point of time, equity markets can fall 10%. Reason being that, according to me, that's the inherent minimum level of volatility in markets, right? When we talk about volatility, We basically mean that the asset class has an inherent level by which it would tend to fluctuate, right? And as long as your longer term returns adjusted for volatility are better, that is why you should invest. So just based on that thought process, I would say at any point of time, a fall of 10% should come as no surprise. And if I look at the history of the Indian markets over 20, 30 years, which has been my experience, I would say that every year you should expect that the falls could be at least one fall of 10%. Every sort of 3 to 4 years you tend to see falls of 20 to 25%, and once every 10 years you end up seeing falls which are closer to 40 to 50%. So if you are talking about an investing journey of about 30 to 40 years, that is the past experience. And I think in the absence of anything else, that is a good enough model to think about in terms of what the future might look like.
Thank you, Vetri. Again, the next question that we have is on the markets only. So the question is that the corporate profit to GDP as a percentage is on a rise over last couple of years. There are some pockets or some sectors which have contributed to the growth, and there are some sectors which have actually delivered sluggish growth. So what is the view on those sectors?
So, good question. And there is certainly some mean reverting tendency of aggregate corporate profits to GDP, because profits cannot continuously grow faster than GDP. Mathematically, then eventually at some point of time, profits would end up becoming larger than GDP. So that is not possible. So that's the simple principle why corporate profits to GDP are mean reverting. But having said that, if you look at both India's experience as well as US experience, honestly, those numbers can move around quite violently. It doesn't help you very much in terms of taking active investment decisions, because these are very long cycle numbers, and particularly in terms of identifying companies or in terms of identifying sectors, it doesn't help you, because as an economy evolves, as technology evolves, what we find is that the share of profits coming from a particular industry might actually change very dramatically. And the second point to make is that the share of profits may not correlate to the share of market cap, because market values profits very differently, and that is a function of what it believes future growth might be. So if you look at the share of profits coming from oil and gas, it would be much larger than the share of market cap that is given to oil and gas. So I think trying to interpret profit to GDP to market performance, not my favorite strategy. I would not recommend it to anybody.
Thank you, Vetri. So the next question, Sharwan, is for you. So there is a question that gold has delivered very good results in last couple of months. And for example, last 1 year, the gold's return were close to 13%. So what is the outlook on gold going forward? And what would be the kind of tentative allocation of gold in the multi-asset allocation strategy?
Sure. So see, we don't have a very strong view on gold, but generally because equity and gold has negative correlation to each other. So whenever gold has performed well in that period, we are reducing allocation towards gold. So for example, as you mentioned, gold has performed far better as compared to equity and fixed income in last 1 year. So that's why model has signaled reduction in gold allocation from 25% to 10% in last 3-4 months. So currently we are having about 10% allocation towards gold. But if gold falls slightly, maybe 2-3-5% from here on, then model may signal slight increase in the allocation towards 15% kind of range. But currently, because gold has performed much better, model is signaling reduction in gold allocation to 10%.
Yeah, just to add to what Sharwan said, I think main thing to remember in the multi-asset fund model is that we are not trading gold as an individual asset. We are trading gold relative to equities. So for us, what matters is the relative attraction. Is that needle pointing in favor of gold, or is it pointing in favor of equities? It's not an absolute level call on is gold good or is gold go bad. We are more interested in which asset class will outperform, and that's the principle which is built into the gold asset allocation in the context of the multi-asset fund.
Thank you. So the next question, Vetri, is for you, is that government's capex budget to encourage manufacturing through PLI scheme is on rise in last few years. However, is there any change in the sectors or the focus and the impact of structural push to manufacturing numbers coming from China plus one strategy?
Very good question, but I think we need to take a pause and just step back here for a moment. If you look at Government of India's intention in terms of what they have allocated towards PLI, obviously these numbers might change. It is about 2,40,000 crores to be given effectively as subsidy. It is a subsidy to manufacturers to compensate them for lack of scale, lack of integrated supply chains, etc., etc. But 2,40,000 is to be given over a 5-year period. Right. So 2,40,000 crores roughly equals about $30 billion. Take a little bit, just rounding it off, $30 billion over 5 years. $30 billion over 5 years means that is about $6 billion a year. Now, please remember, India is a $3.5 trillion economy. I showed you in one of my slides that our investment rate is somewhere between 29-30%. It's in that range, which means in a $3.5 trillion economy, you are investing anyway $1 trillion as investment in the economy every year. Now, in $1 trillion investment, I am not sure that $6 billion of investment actually moves the needle. Right? Because $6 billion divided by $1 trillion of investment is only 6%. So I think the important thing to remember about PLI is that I am not sure that it gives enough momentum at an aggregate economy level in terms of an impetus. It can certainly benefit certain companies. It can create manufacturing jobs. All of those will be positives. But at an economy aggregate level, I am not sure this program in terms of the dollar spend is good enough to say it will create a capex drive of its own. Independent of that, many companies for valid geopolitical reasons are looking for manufacturing bases outside of China. It could be Indonesia, it could be, of course, Vietnam is the #1 destination, but India is also a very attractive market to them, and therefore manufacturing in this market becomes sort of a double advantage. So I think that is the reason why India is figuring on their radar. PLI helps us bring in some high profile investments, Apple, for example, Samsung, for example. So it gives us good talking points, but the spend itself is not enough, in my opinion, to trigger an economy wide revival in spending or in capex.
Thank you. Shravan, the next question is for you. So considering the multi-asset actually invests across asset classes, so what is an ideal investment horizon for an investor to consider this fund first? And the second part of the question is that, is this fund also suitable for first-time investors?
Right. Ideally, multi-asset fund kind of fund is very appropriate from longer term perspective because it is giving you exposure towards different asset class which are not linked to each other. So which means that first-time investors who is new to market can look at this kind of strategy because he doesn't have to worry about allocation towards 3 different asset class. This particular fund is giving allocation towards all these 3 asset class, which is appropriate for most of the investors. So it is suitable for first-time investors. In fact, somebody who is having just one fund, this could be the fund, because you are having allocation towards all 3 asset class. So it is suitable to first-time investors. At the same time, one should have allocation towards multi-asset kind of fund from longer term perspective, because you are getting exposure towards different asset class which could perform well in different period.
Thank you, Shravan. So the next question, Vetri, is for you, that there seems to be a turnaround in the performance of funds following quality style of investing. And this is likely to sustain. And what should be the approach of investor towards value set of funds? You have to unmute yourself.
Interesting question. I think in previous conversations, as well as when Ajay Tyagi has spoken in this webinar, he manages UTI FlexiCap, our head of equity. He's talked about the rotation between value and quality growth as a strategy. It is true, quality has seen a little bit of a leg up recently. And I think, the historical pattern is that typically these things do sort of keep changing as seasons come along in the marketplace. We have seen sustained underperformance of quality relative to the markets and certainly relative to value for almost a 18 to 24 month period. So I do think, the trend based on historical parameters was already quite mature. I don't know if we can predict exactly the point of inflection where the pattern changes, but I will just point to something I had replied in a previous question, maybe last month or the month before, which is that if we have entered an environment where growth is now looking slightly more subdued, if we have entered an environment where cost of capital is elevated, then the needle is at least come back to the midpoint, because now cost of capital becomes very, very important, and a typical quality growth strategy tends to emphasize companies which have high return on capital, and in a high cost of capital environment, these are the companies that are better placed to deal with challenges. And typically the value segment of the market tends to be dominated by a lot of cyclicals, including global cyclicals, and the current environment is not very favorable for them. So I do think the needle has at least shifted halfway, if not completely, towards quality growth, but certainly it has shifted halfway, and that's why we are seeing enhanced performance. But we'll just have to be patient and watch.
Thank you, Vetri. Shravan, the next question is for you. So we are seeing a lot of momentum around smart beta funds. A lot of talk is going about the smart beta as a strategy or the factor-based investing. Can you throw some light on factor-based investing? And second part of the question is that what kind of investor those factor-based strategies are suitable for?
Sure. A smart beta are enhanced indexing strategy. So smart beta funds are trying to exploit certain performance factors in order to get desired outcomes. So for example, momentum as a smart beta strategy tries to generate maximum returns, but at the same time, volatility of momentum is also pretty high. And momentum kind of strategies agnostic to either quality or growth. So whichever side momentum is shifting, momentum will pick up that particular style and then keep on riding on that particular segment of the market as long as momentum continues in that particular segment of the market. So in last couple of years, we are seeing value performing far better. So currently momentum is tilted towards value, but every 2, 3, 4 years, we have seen that there's a shift from one segment of the market to another segment of the market. Similarly, say quality and value kind of strategies, which performs well in different market environment. As Vetri has also alluded that generally value performs well during economic recovery. So whenever there's a very sharp economic recovery, we have seen that value performing far better because it is getting benefited from cheaper interest rate, and at the same time earnings growth of these companies is far better as compared to longer term averages. But we have seen that value has already performed well in last couple of years. So currently there could be shift towards quality maybe 6 months, 1 year down the line, or exactly difficult to know at what time the shift will happen. Can you just read through the second question?
So what kind of investor the smart beta factor based investing is suitable for?
Sure. So typically we advise first time investors or investors who are new to equity markets. They should ideally start with broad market cap based funds, in the sense that they can invest in large cap, mid cap, and flexi cap kind of funds. Once they understand the nuance of these smart beta strategies, once they understand the risk and return profile of these smart beta strategies, then they can start looking at these kind of funds. So for example, first time investors can start with low volatility kind of funds, because these kind of funds have delivered much better risk adjusted returns as compared to some of the aggressive investors. And typically volatility of low volatility strategy is much lower as compared to any other smart beta strategies. So for first time investors, low volatility could be better strategy, but people who understand the nuance of these strategies, who understand that which side market is going towards, market is heading towards that particular style, in that case, investors can choose to invest in that particular smart beta.
Thank you, Shravan. So Vetri, the next question for that matter, the final question for you is that in the current environment where there is ample availability of information, it is very important for investors to kind of segregate between what is noise and what is signal. So what is your words of wisdom with respect to investors, that how they can identify between various information available in the market?
Sure. So I think, that's a very thoughtful question and also a difficult one to answer. I would say, broadly speaking, unless you are able to second guess the market well in advance, trying to use macro to, take your investment decision in stocks, trying to use news flow to trade stocks is very difficult, because as that news flow comes into the market, the stock has already digested it. So in a sense, I think what you need to focus on is the fundamental parameters of companies, their metrics, and some sort of obviously this will involve taking a view on what you think are the longer term prospects of a particular business. So I think eventually, all investing has got to do with the future. The future is always uncertain. You have to deal with uncertainty. There are ways to deal with that, whether it is by diversification, whether it is by making sure you don't have certain kind of terminal risk associated risk with the businesses that you invest in. But primarily it comes down to choosing businesses which have reasonably good operating metrics, fundamentals, and valuations which give you some margin for safety. I think that is eventually what it comes down to. Trying to read the trends, trying to read the macro is very counterproductive. The only way macro works, and what we have seen in history from across the world, is that macro is very good if you are running a macro hedge fund which trades everything from commodities to real estate to stocks across geographies to currencies to fixed income. But using macro in equity strategies and trying to continuously readjust to trends actually is very counterproductive.
Thank you, Vetri. So, friends, we have broadly taken all the questions, and for any further questions, please feel free to write back to us. And with that, I'll again hand over the call to Vetri for his closing remarks. Thank you.
Sure. Thank you, Ankit, for hosting this call today. And thank you to Shravan as well for joining us. I hope you found this session useful. And any further questions you have, do feel free to reach out to us. You can write to us. The email ID. We love to receive your questions, because that way we can also make sure that whatever we talk about during the session can actually be targeted at some of the queries you might have. So thank you very much for joining us on this session today, and we look forward to connecting with you once again next month in July. Have a great evening.
Thank you, Vetri. Thank you.
Recording stopped.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.